AMD is a global semiconductor company. They design, manufacture high-performance CPUs, GPUs, as well as other technologies which are used in personal computing, gaming consoles, servers, and most importantly, data centers. Now, the performance of advanced micro devices has been nothing but torrid over the last year, down 5%, year to date, down 13%, over the last 6 months, down 20%, over the last months, last 5 days, and even over the last day. This company just continues to be on a decline. Even right now, it is trading right there towards its 52-week lows, yet we get a double buy signal from both Seeking Alpha and Wall Street, with Quant giving this a hold. So is this company now looking like an absolute bargain at its 52-week lows with a lot of growth baked in? That is something we are going to find out in today's episode. Also show you our own valuation process for AMD. But what we have noted just over the last week, the market as a whole has started to turn bearish, quite a lot of red throughout, and notably semiconductor space, we can see every single company for the large part is down, although AMD alongside Intel has been one of the worst performing. Now, we have some reasons for this poor performance from advanced micro devices, and one of them in which we would classify as a very silly reason for the market to punish this company is that the Bank of America has officially downgraded the price target, and the reason that they have put down here is due to potential market share losses. Now, it is just one analyst, as we can see here from the Bank of America, and they've downgraded it from a buy rating to a neutral. Now, they still do see upside, but their price target has been lowered from $180 to $155, and they believe that there are some issues with this company moving forwards. They classify them as high competitive risks in AI against the best of breed Nvidia's dominance. So ultimately, they don't see the increase in market share, the increase in the share price that they once believed they did. And as we can noted, based on that, they have reduced it. The reason why we say is a bit of a silly reason is due to the fact it's just one analyst from the Bank of America, and really you shouldn't see markets move on such news. But there we have it. Whether or not it is justified, something we can look at through the numbers. Now, Jim Cramer, he is quite a famous analyst on CNBC who is followed by many people. He was very bullish on the stock, and he has come out recently saying that the call does have some merit in terms of the downgrade, but not enough to shake him out. It is still one over the longer term that he does classify as a buy, and believes that this company alongside Nvidia will be very strong in the AI market. Whether or not that is something you do want to use in your own investment thesis of interest, just something we highlight. Very similar to the fact that what we did find just a few days ago is that the CEO, Lisa Su, is the Time CEO of the Year, which is very interesting. We just had a look at the company, and over the last 12 months, the performance has been nothing but terrible. But one thing we would say with regards to that is that the share price return doesn't always follow the fundamentals, and that is what the aim of the episode today is, to understand, are there strong fundamentals? Can we in fact see this company as one with massive growth? If we look at just over the last 10 years, this company is up more than 5,000%. They have had some very strong performances, but also along the way they have had some bumps. In fact, in 2022, around 2 years ago, this company was trading at $58, and then we did see it at all-time highs in March this year, not long ago, at over 200. As we said, trading at its 52-week lows, it does have a forward P for 38, which we will discuss in a little bit more detail, but we also want to run through a few things today. First one is how were their earnings, because we also saw a drop in the share price when they did release that, and as we can see, their forecasted failed to impress the analysts given the strong AI growth that they did see in the numbers. And as we always repeat, because it is incredibly important, with companies priced very high, we've shown it before, forward Ps looking very, very large in comparison to historical rates. Analysts want to see right now companies that extend their guidance even further and are not satisfied with just companies that guide in line. And if they guide lower, they will be severely punished. As we can see then, 92 cents EPS came in pretty much in line, and revenue was a very marginal beat. However, what we can see, their important data center, one area we're going to touch upon, doubled in sales for the second quarter in a row. However, their guidance for the fourth quarter was in line with analyst expectations. As we just said, companies that guide in line with expectations will likely, with high forward PEs, be severely punished. And as noted, they were down around 9% following this release. What is very nice to see though, their bottom line, something that isn't always talked about, came in at 771 million. That was up from 299 in the same quarter last year. So if you do look at that guide as something which is still very strong, we can see their numbers have been fairly decent. Yes, EPS was in line, revenue did have a marginal beat, and there is still some large growth across the board, which we are going to show you. And speaking of growth, we're going to take a look at their earnings over the next 4 quarters. Every single one of them, they do anticipate to be double-digit year-on-year growth, very strong. But what we always like to do is look at how they performed in the last 4, and at a bare minimum, they have been in line. Even the 2 that they have beat were very marginal. So ultimately, I would say this does give us some faith in their historical forecasting accuracy, that we can believe they will hit there or thereabouts their EPS at 5.11 in December next year, the full accounting period, which in turn will lower the forward PE to 25.01, which does look a lot more reasonable. Now we can continue the theme of their earnings by just looking at their latest investor presentation. Now they have shown their revenue from the same quarter last year is up around 18%, and they do attribute a lot of this into the growth from the data center, and that is one area we have seen in artificial intelligence companies like Nvidia that are really showing massive growth. Although if you have watched our Nvidia videos, you will see the impact on data center growth is significantly larger. We then look at other parts of the company, some things that maybe you don't always think about. The margins are very important for us. We want high quality companies in our portfolio, increase their top line revenue that AMD did as we saw, but also increase their margins, give us some efficiencies, and again we can see that both on a GAAP as well as a non-GAAP basis, they are climbing higher, and as we saw, so was their revenue. In terms of their operating income as well, looking good across the board, increases as well as their net income that we did mention earlier, and their EPS, something that we always want to see drive up higher as the quarters go on, as the years go on. Again, this does tick the box. For those that just want to see a quick summary of their latest quarter, but on a year-on-year comparison, their revenue is up double digit, their gross profit is up double digit, their margins also up 3 percentage points. We get the operating margin up, something we will cover later on, but we also want to see operating efficiency, and their bottom line up triple digits as well as their EPS. So there is still a lot of growth here with this company, and it does feel like the market has overshadowed this company due to the fact that Nvidia's taken the spotlight. It has been very impressive in its growth consistently. But look, in terms of their financial outlook for the next quarter, they are anticipating 7.5 billion, and as we just saw, they reported 6.8 in Q3. So there is still growth to be had with AMD. You could argue Nvidia is a lot larger, and that would be correct, but we have also seen Nvidia's share price really skyrocket, not just over the last 10 years, 5 years, but also triple digit gain in the last 12 months. And we want to identify companies that maybe the market has overshadowed, maybe the market has overreacted, neglected, and it does look like AMD could be one. Now, we had an investor conference not too long ago for AMD, where in fact they did talk about 60% growth in data centers. That is a CAGR, which means compounded annual growth rate. Every single year, they believe that the acceleration of data centers to the numbers will be at that rate. And as we can see, it would move from 45 billion total addressable market to 500 billion in 2028. Now, this isn't just bullish for AMD. Lots of other companies, notably Nvidia, will also see this impacted, and therefore we need to start thinking about the future. How will the companies in our portfolios benefit from the rapid increase that AI will bring to certain industries and certain companies? Now, we do have other parts of our analysis that notably include insider and institutional movement. Starting with insiders at 0.65%, we see around 96 million worth of sales over the last year. And when we do take a look at the more recent quarter, we see around 28 million. Now, for transparency, we will show you who these insiders are, but as we always say, we don't take this personally to be a bearish signal. They sell for many reasons, personal and financial. Just last week, we had the CEO sell around 76,000 shares that netted her just under $11 million. Again, information is there if you do want to use it as part of your own process. Then we take a look at institutions that sit at 71%. We see just under 10 billion worth of sales over the last year, but we see double the amount of buyers. So institutions clearly very bullish on advanced micro devices, but we also see in the most recent quarter they've been buying more than they have been selling. Now, something that we always say, because it is incredibly important, yes, we do keep mentioning, but always do your own due diligence. Never copy insiders, never copy institutions, and always have your own investment thesis before executing on companies. Now, we also want to let you know we have released our latest free weekly article. This one highlighted one stock we are heavily buying this month. Now, we release one every single Monday morning to your inbox where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and start reading straight away, where you'll also be able to gain access to 28 undervalued stocks for the month of December, a lot of information for each one, as well as the upside that Wall Street themselves see over the next year. And on top of that, you can grab a recently released spreadsheet of 29 stocks that Wall Street themselves believe have the most upside right now in the S&P 500. So click below, you can sign up, and as we said, start reading straight away. Now, we also want to highlight some of their underlying metrics, the first one being the free cash flow. As always, we don't look at the earnings data. It is susceptible to manipulation by management through accounting, but it's there if you do want to analyze it. So the free cash flow, we want consistent increases over the long term, but what we do notice, semiconductors as a whole in a very cyclical industry, and that does shine through the numbers. In fact, it reached a peak in 2021 at 265, came down the subsequent 2 years, but over the next 12 months, massive growth is anticipated to $3.92. In terms of sales growth, again, cyclicality coming through, but some years have been absolutely phenomenal, like 2020 to 2022. Now, the more recent annual accounts does show a drop of 4%. However, on a trailing 12-month at 10%, does indicate to us that 2024, which is closing very soon for them, given the December year end, will show some nice growth. Now, we like to highlight the shares outstanding. We want companies that return excess cash through share buybacks. However, AMD have actually diluted your position over the longer term. In fact, more than double from the shares outstanding in 2014. What we would say for this company in particular, you probably wouldn't care given how much the share price has increased over the last 10 years, massively outperforming the S&P 500. And total sales, we can see, in fact, more than 4x over the last 10. In terms of ROIC, this is one of our favored metrics. We want 10% or more. Give us faith, management are able to effectively allocate their capital. Very inconsistent as the numbers show, so do bear this in mind. But what we always like to do in terms of our valuation towards the end, when we run it through a DCF model, is do a little bit of a margin of safety to really help adjust for some of these issues or some of these small things that we have picked up. In terms of the operating margin, we want to see 16% or more. What we have noticed, it is very inconsistent again, so something else that maybe you do want to consider, and likewise, that also applies to the free cash flow margin. We move on to the net debt to EBITDA, referencing the earnings before interest, tax, depreciation, amortization. This tells us the number of years it would take the company to pay off all of their debt net of cash on hand, and also correlates to balance sheet strength, 0 from 2019 and on a trailing 12 month and over the next 12 months, telling us it won't even take AMD 1 day to pay off all of their debt net of cash on hand. Definitely a very strong balance sheet. Then we continue our analysis into the income statement. Now, we've already highlighted their top line revenue, as we said, around 4x over the last 10 years. But what we really want to highlight is the story in terms of the bottom line net income. Does it follow suit? Is there a little bit of a different story to tell? And what we can see, inconsistency does continue. Whilst they are growing their top line revenue, we would typically anticipate their bottom line net income to grow. Actually, a different story here. We can see a lot of inconsistency and not the growth we want to see. Although on the trailing 12 month, we are anticipating, again, 2024 to be a very strong year. Nice jump from 2023. Then we look at the balance sheet, a quick health check. Now, we did already say the net debt to EBITDA does show strength, so we're just going to highlight that here. Cash versus total debt. 2014 to 2023, cash has increased quite significantly, 4.5 times from 1 billion to 4.5 in the latest quarter. And then we move on to their total debt as a comparative. Remember, one number in the balance sheet won't tell us anything. So therefore, we see the total debt, which actually, whilst it looks very inconsistent, has barely moved over the period from 2.2 billion to 2.2 again. And remember, their cash is far superior. And as we said, won't even take them 1 day to pay off all of their debt net of cash on hand. We also want to highlight the cash flow, but in particular the cash this company has been generating from their operations. And what we can see, again, very inconsistent, although over the last 12 months they've generated around 2.1 billion, and we can just see over the last few years it has been very up and down. Again, just things that you do need to consider in your overall thesis and possibly in your own margin of safety. Now, the first gradings that we're looking at is the valuation, where they get a C+. Now, the forward P on a non-GAAP is coming to around 39, which, as we have noticed, is in fact above the sector at 27. So right now, if you're buying AMD in relation to the sector, you are paying a 48% premium, and that is something that is reflected in the vast majority of valuation metrics you do use for this company. Does it deserve a premium? How much of a premium? Questions we need to think and questions we will answer. First one, does it deserve a premium? Well, it gets an A on growth, which is good given it does trade higher than the sector median. 10% over the last year in terms of revenue growth, 4.3% for the sector. Moving forwards, 11%, sector at 5.7%. And we can see one thing that really stands out for us is their earnings per share over the next 3 to 5 years on a compounded annual growth rate at 42%, the sector in comparison at 15.4%. So yes, it does look like a premium is warranted, and we can also see on the profitability it does also look good with a B+. Gross margin not far off, to be fair, 52 versus 50%. Bottom line looking better, 7.5 versus 3.98. And then we get to their cash from operations, which does look a lot better, 2.12 billion versus the sector at 97 million. Now, just a quick recap for this part of the analysis. Double buy rating from Seeking Alpha on Wall Street, hold from Quant, C+ on valuation, A on growth with a B+ on profitability. Now, two more things before we do jump into the valuation model. We're going to compare it against others in the semi space of a particular size. Now, we're looking at this company in terms of the return over the last year. It is the worst performing, down 5%. We have Qualcomm, Texas Instruments, ARM Holdings, Micron Technologies, as well as ADI. And we can, in fact, see all of them have performed a lot better. Question is this company in isolation in terms of the poor performance? It does look so, as the others in the sector have performed fairly strongly. Over the last 5 years, however, it goes from being the worst performing to the best performing, and over the last 10, as we've already highlighted, very, very strong performance. We need to remember that past performance is not an indicator of the future. They could perform a lot better over the next 10 years, but they could also perform a lot worse. Now, you probably already know the answer, but let's just compare it to the S&P like we always do for consistency, and this is just to highlight that over the last 10 years, this company has massively outperformed, and the reason we highlight this is just to consider, look, if you don't have faith in companies over the longer term that they will outperform, then you could consider a low-cost ETF to track the S&P. Now let's jump into the valuation model. As always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, our intrinsic value at $189, we got this by putting it through the DCF model, where we have the free cash flow year on year. Average growth is skewed given it has gone from negative to positive. Now, we've gone for a 30% growth rate moving forwards. With that and the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and we can see the intrinsic value giving us our undervaluation signal, and here in turn giving us a 47% upside from the current share price. Now, these numbers are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for AMD or any others, but we'll show you, look, for full transparency, at the 25%, if you believe that is more appropriate, $142, indicating 11% upside, with the 35% point, $250, 95% upside. And we have talked about Bloomberg over the last year, where they've said this industry as a whole will increase 42% year on year. And again, for consistency, just to show you, 365, which would mean 186% upside. That is nearly a 3x from the current position. Now, as always, we will take the medium rate through, where we do apply a margin of safety on this channel. As always, 10%, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. If you believe that in today's episode will buy at $170, then we keep going till it's near the current trading price. And what we can see in today's episode, this company is trading at a very large MOS, not at 35% just yet, but essentially up to around $132. This company does look to be a buy at 30%, if that is sufficient for you, given some of the things we did highlight today. In terms of Wall Street, very, very bullish, $188. They actually weren't far off, giving this a strong buy rating, and we can see 47% upside over the next year. So as always, do give us your thoughts. Is this one you are considering with the 30% MOS, 47% upside? Is it a buy for you, a hold, or maybe you have sold or are looking to sell? Give us your reasoning below. If you enjoyed the episode, value was provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Don't forget to sign up to the free weekly newsletter below, grab those spreadsheets, and come and join us in the Patreon where we do talk about our weekly buys and sells. As always, have a great day, and we'll see you all on the next one.